Good evening everyone, welcome to today's financial market report. Let's start with the closing numbers. U.S. stocks ended the session with modest gains. The Nasdaq rose 0.2% to 26,972.62, the S&P 500 added 0.22% to 7,580.06, and the Dow Jones climbed 0.72% to 51,032.46. The VIX Volatility Index fell back to 15.32, indicating that risk appetite among investors has not wavered. However, on the other side of the Pacific, Chinese stocks took a significant hit. The Shanghai Composite fell 0.73%, the Shenzhen Component dropped 1.81%, and the Chinext Board plunged 2.11%, making it the only major global market to show a notable decline today. This divergence is the most important takeaway of the day. US and Chinese stocks did not move in tandem. Instead, capital is showing a high degree of selectivity across regions and sectors. This is not a broad-based recovery in risk appetite, nor is it a systemic sell-off. It is a localized rotation of capital within a consolidating market. Let's break down the capital flows. On the US side, within the AI theme, we saw a rotation from high-flying names to mid-tier and application software plays. Some money also moved into defensive sectors like energy and utilities. Gold was squeezed by a modest rebound in the dollar, while cryptocurrencies attracted independent buying interest driven by geopolitical developments. In China, capital flowed out of earlier high-growth tech names and rotated into high-dividend and summer demand sectors such as coal, utilities, and telecommunications. The overall picture is that money is not leaving the market. It is being rebalanced structurally across assets and regions. Now let's review the global path. In Asia, Chinese stocks opened lower and weakened throughout the session. The Shanghai Composite fell 0.73%, while the Shenzhen market and the Chinext Board faced even greater pressure, dropping 1.81% and 2.11% respectively. Investor sentiment was clearly cautious. The computer, defense, and conglomerate sectors led the declines, indicating profit-taking in earlier high-growth tech names. Coal, utilities, and telecommunications bucked the trend, reflecting a proactive shift into defensive and value-oriented assets as technical overbought signals emerged. Hong Kong's Hang Seng Index fell 1.65%, with tech stocks seeing a modest 0.3% bounce, but the follow-through was limited. Japan's Nikkei was the standout, surging 4.72% to lead global markets. This move was driven by domestic economic data and policy expectations, not by a spillover from US tech sentiment. European markets were mixed, with Germany's DAX up 0.87% while the UK's FTSE 100 fell 0.54%. In the US, futures edged higher before the open, and the three major indices traded in a firm but range-bound manner. The Dow led the gains, suggesting a rotation into traditional industrials and financials. But beneath the surface, Nvidia fell 1.41% and Tesla dropped 1.02%. Investors were taking profits in the megacap tech names and rotating into AI software plays like Datadog and midstream companies benefiting from AI computing demand. Bitcoin proxy MSTR gained 4.77%. The overall path was a firm open that held steady, with no signs of a late-day fade or panic. Let's dig into the key expectation gaps today. First, the dollar index DXY edged higher to around 99.00. Normally, a stronger dollar would pressure emerging markets and risk assets. But US and Japanese stocks did not decline. This suggests that domestic US risk appetite is relatively insensitive to a modest dollar rally, which is a constructive sign. Second, the 10-year US Treasury yield fell to 4.45%, a drop of 4 basis points. Lower yields typically support growth stock valuations, but Chinese tech stocks sold off sharply. This is a bearish signal, indicating that Chinese market sentiment is disconnected from bond market logic. Third, if the morning call was for US strength to lift global risk appetite, then the sharp decline in Chinese stocks was the biggest miss. The reason for this error is that we overestimated the speed and strength of the transmission of U.S. tech sentiment to Chinese tech stocks, while underestimating the technical overbought signals and the profit-taking pressure within China's own market. Looking at the three-way linkage between currencies, equities, and bonds, we see a clear divergence. The dollar firmed modestly but did not trigger panic in emerging markets. Treasury yields fell but did not boost Chinese tech. This means the market is being driven by highly divergent forces. U.S. stocks are being driven by AI industry fundamentals and risk appetite, while Chinese stocks are being driven by internal capital structure and domestic fundamental expectations. The takeaway for tomorrow is clear: Chinese stocks will not simply follow the U.S. direction. Investors need to independently assess domestic liquidity and technical conditions. On the capital flow front, the strongest themes today were U.S. AI mid-tier and application software, and Chinese coal and utilities. The weakest were Chinese computer and defense stocks. The most consistent theme over the past two sessions has been the rotation into Chinese high-dividend defensive sectors like coal, utilities, and telecommunications. This has now appeared for 2 consecutive days and may be forming a short-term trend. Looking ahead to tomorrow's trading, there are several key points to watch. For the Asian Open, Chinese stocks are expected to open slightly lower or flat. The Shanghai Composite may trade in a 40.50 to 40.80 range, while the Chi-Next board still faces downward pressure. If the Chi-Next falls another 3% or more in early trading, some AI-related names with good earnings and reasonable valuations may be oversold, creating a potential rebound opportunity. However, the probability of this is only about 45%, so caution is warranted. Tomorrow is also the first trading day of the month, so we need to pay close attention to China's Caixin manufacturing PMI data. If the reading comes in below 50, the contraction line, it will accelerate the rotation into defensive sectors. If it comes in above 52, it could trigger a weak bounce in tech stocks. The market will likely make its directional choice within 30 minutes of the data release. Let me wrap up with our trading conclusions. The recommended stance is a hedged approach. Go long U.S. equities, particularly the AI theme, while avoiding Chinese Chi-Next tech stocks. Focus on Chinese defensive sectors instead. Our strategy for tonight into tomorrow morning is to maintain controlled long positions in U.S. stocks and commodities, while keeping a light position in Chinese defensive sectors. We would consider adding to positions if U.S. futures hold their pre-market gains or if the Caixin PMI data comes in better than expected. However, we would abandon this plan if U.S. futures decline more than 0.5% before the Asian Open, or if S&P 500 futures break below 75.50. Our probability assessment for tomorrow is 50% for an up day, 20% for a sideways day, and 30% for a down day. Thank you for watching, and we will see you tomorrow.